Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering 5 stocks with ex-dividends next week. This will be episode number 4, covering August 28th through September 1st. So I do have 5 stocks for you guys. Whether we're going to be looking at whether they're undervalued or overvalued. We're going to look at their 1-year and 5-year growth, their payout history, and their dividend history. If they can continue to pay out their dividends through times of recessions or pullbacks. So of course, if you're brand new to my channel, I do make stock market, dividend, investment, and financial videos daily, so do consider subscribing to my channel. So the very first stock that we're going to be covering is Qualcomm, and ticker symbol is QCOM. Now this is a semiconductor and telecommunications equipment company. It's been around for quite a while, and this is actually a stock that I had taken a look at earlier and just had decided to pass over it for the time being. I was waiting for a better opportunity. So I did see this one coming up next dividends next week, and I thought I might add it to this list. So taking a look at their 1 year, let's go ahead and remove that dividend. We can see that their dividend yield is 4.13 on this chart. Now that's already showing that it's way overvalued compared to their price to yield. Their price down here is $52.36. Now there was a time back in early January of 2017 and prior where their price was in the $67 range for quite a while. Right now you can see that for the past year, as of about February, their support has been around $52, and they fell down probably about 20% here, 60, 67, 65, all the way down to the $50 range. That's about a 20% loss. Now they regained what looks like half of it, so about 10%, lost 10%, gained 10%, and lost back another 10%. So this may be a good time to buy as they hit their support again. Now it looks like they fell below their initial support bar for the past pullbacks, but this might be even a better price to buy, where you would get a yield of what looks like 4.13. But of course, if we move over to our 1 year QCOM stock, we can see that their actual dividend yield is 4.36. Now why? Because they recently increased their dividend payout in the last quarter, and they haven't increased this quarter as well. You're going to get 57 cents back for each share of QCOM stock that you currently own. So they were paying about 53 cents a quarter, 53 cents, and they just increased it to 57 cents back in June time frame. So right for this upcoming dividend payout, you're going to get 57 cents for investing $52 in a stock. So they currently dividend yield 4.36. They have a nice price to earnings of under 25. So it's hit my rule of having a price to earnings of under 25. So that's nice. So let's take a look at this graph here for the year. So we can see that they lost. You can see that they estimated about 20% on the down. Now they had another increase of about 10%, another decrease of about 10%, another increase of about 13%, and then have gone down about another 12%. So whatever they gain after this dip, they didn't hold it very long. It fell as quick as it came, and then they went up again and they fell again. So right now, their last growth period was about 12.5%, and they're actually down 11.69%. So this may continue to fall. Or taking a look at their 5-year, we can see that they had a bottoming out point right here in August 21st, and since August 21st they have been on their upwards for 2%. So this might be a good time to buy into the stock to see, will it bounce back up to this $56 range, even higher, $59 range, even $56 range. That would be a price difference of about 7.8%. So it could be a good time to buy. Now let's take a look at their dividend history. So they pay out $2.28 per year for each share. That is 57 cents a quarter, or 4.36% yield for the current annualized payout to price. They pay out 62.3%. So my price for payout ratios is I like to purchase stocks that are 60% or below, or around 60%. I can make an exception depending on their dividend growth for the past years. Now, I like to see that the dividend growth has remained stable through past recessions. We'll say 2008, 2000 recession. So we'll take a look at the bottom here. Excuse me. You do need to own the stock on or before Friday of this week to be eligible for the ex-dividend date on Monday of next week. Then you would be paid out on September 20th. They have had annual growth of 11.3% for their dividend. That is above average, whereas most dividend growth have about 5 to 8%. And of course, if you do have 5 or 8%, I like to look at the dividend growth, because if you know the rule of 72, you can calculate, we'll take 72 divided by 11, so you can see that your initial buy-in into QCOM, if you were to buy, say, 100 shares, your investment, your dividend payout would automatically double what they were paying you within 6.5 years. If they kept up with their annual growth of their dividend, you would see double the payout within 6.5 years. That's why that compounding is so nice. You take that dividend pay, you reinvest it into the company, and with 6.5 years, you're definitely going to be making at least or more of what you were initially making when you first invested in that company. Now, they say that they've been paying out dividends since 2011, so I'm going to take a look at 2011 time frame. And 2010 was 19 cents, 2011 was 21 cents, 2012 was 25 cents. So it doesn't look like this information up here is accurate. This says 6 years, but they've actually had good continued growth for well over 20 years. You can see that 2007, if we took that, 10 years would be 2000, actually, let's see here, 2004, so almost a little over 15 years. We'll say 13 years of continued dividend payout and increase. They even did a stock split here, and they continue to pay out 7 cents for each share after a 2-for-1 stock split. So this company here, it might be on a nice buy, but of course that is completely up to you guys. You guys would continue to do additional information, listen in on their earnings call. What are they doing for their future? How long has the CEO been in position? What's his outlook for the future? What are they investing in, etc. So the next stocks we're going to be taking a look at is Six Flags Entertainment. Ticker symbol SIX. Now this, of course, is an amusement park corporation based in the United States with properties in the US, Canada, and Mexico. So right now, looking at their stock, they're not doing so hot. Taking a look at their price and dividend yield, their yield is at 4.7%. That's pretty high. But as of May in 2017, where you would expect their stock to go increase during the summertime, it's actually been doing a downward. So this stock hasn't been, the stock prices depend on how much want and need that specific stock, because it's all based off investors, how much they're willing to put into it, the need for it, the want for it. So this hasn't been really wanted lately, so it's kind of feeling lonely, and it has dipped from, let's see, about $63 down into the $53 range. So that's a 10% or a $10 loss there just within a couple months. Their dividend yield does show that they're a little bit undervalued, but let's take a look at their 1 year and 5 years. So ticker symbol SIX. And take a look at their 1 year. They are up for their 1 year about 5%. So that's pretty decent with their dividend yield. Their price to earnings is very high. So they are overpriced right now comparing to their earnings. And for their 5 year, let's take a look at their 90%. So 90 by 5, I believe that's 18. Boy, I was off by a little bit. So 18% average per year, so not a bad stock overall for the past 5 years. Now they have had this huge spike as of maybe they went public. It's kind of 3 cents in 2009, so that may or may not be accurate, because you can see that that's a huge gain right there. So I'm just going to go ahead and just stick with the 5 year here. and we've already covered that. So they have been up on the 1 year and 5 years, so this could be a buy and hold. I'm going to take a quick look at their, let's see, Yahoo Finance. Take a quick look at their Yahoo Finance and see how their past quarters have been. Let's see here. So that's pretty high price to earnings. 4.8 yield, which is different than this. So they may have increased their dividend pretty recently. Actually, that's that's Six Flags. That's QCOM. Okay, so where was I? Right here. So they did not meet their earnings for their third and fourth quarter of 2016, and they actually fell below actual making any earnings. They were in the negative in the first quarter and met their earnings. So they were expected to fall below their earnings, and they did, and they met their earnings. They did not meet their second quarter earnings, and they're projected to have $1.88 per share, or 1.88 for earnings per share in the third quarter. I don't believe they're going to make it. Just kind of looking at their path that they've been on, and just their stock overall for the past 3 months, they've been on a downwards hill right here. And this this time frame where everyone's at summer and visiting these amusement parks, you would think that they would be bringing in some nice earnings. So very weird. Payout ratio, red flag right there. 131% being paid out to their shareholders. So that is definitely not sustainable. So right there, right off the bat, that's basically double what I would even consider. 60% below is what I would consider, because the company would be taking its earnings and reinvesting it back into its company. So this company is paying out way too much of its earning back to its shareholders, taking out debt. So if we go over to its financials, we can probably see that. Let's see, what's it in thousands? So it is starting to pull a profit. Okay, so let's see what their debt is. What I'm wanting to look at here. So that would be in their balance sheet, long-term debt, long-term investment. Oh, that's assets. Okay, liabilities, long-term debt. So you can see here that their debt increased for long-term by quite a bit over the last the quarter alone. So that's definitely not sustainable right here. Dividend growth, 7 years. You would have to own this stock on the 29th, which is Tuesday, so you would need to buy it Monday. You'd get paid out on September 11th. Their annual growth is 11.2, but they can't sustain it. And of course, they've been paying out dividends for 7 years. That's why they have dividend growth for 7 years. So they definitely should have increased their dividend payout as high as they have, because it is not sustainable. They're paying out way too much back to their shareholders. Even during the stock splits, they continue to pay out 45 cents per share. So not sure what is going on with their company. That is something, if I was to invest in their company, I would definitely need to do a scrub of that one, because I don't know what they're doing. Next stock we're going to be talking about is Pepsi. Now, I do own Pepsi, and I've owned it for quite a while, and I do enjoy Pepsi. Of course, Pepsi is an American multinational food, snacks, and beverage corporation. So I do choose to invest in Pepsi over Coca-Cola, just because Coca-Cola is mainly a beverage corporation, beverage company, whereas Pepsi has foods and snacks and also beverages. So good all around, more diversity within our company. So as you can see right now, they are currently overvalued for the current price to yield. So their yield is 2.6%, whereas if you bought it in, say, December of 2016, you would be yielding almost 3%. That would have been a great buy, whereas right now it's 2.6%. So bought it back in December, clap yourself on the back or pat yourself on the back, and this one is currently overvalued for the current time being, or you could buy into it. We'll have to look at its PE. So PEP stock. PE ratio is 24.98, so a little bit below what I like to buy in at price to earnings. So I did buy this one. I believe when I bought into it, it was around 16 or so price to earnings. Their dividend yield was, I think I have a 2.84, 2.85 dividend yield. So I am ahead a little bit on the stock. So I bought it back in, see, I started about let's see, we're in August, so July and June. So maybe I bought it right around June. I'm not up very much, but I am up just a tiny bit. I didn't get the average down on my position, so we'll see. Anyways, okay. 1 year, they have really nice growth of 9.31% for their 1 year, and 5 year is growth of 61%. So by 5, that's what, 10.25% average per year with their dividend yield of 2.73. So a really good company overall. Just looking at their PE, their dividend, their growth for their 1 year and 5 year, Pepsi is an all-around, good company. So let's take a look at their annualized payout. They pay out $3.22 per share for a $117 share. They have a payout ratio of 62.4. So again, I don't like to invest in companies over the 60% mark unless they are, blue chip and aristocrats companies. And this one's been paying out continued dividend growth for the past 44 years. And I believe can continue to pay out dividends for the next 30 years while I'm invested in it. So definitely a buy and hold in my eyes. And I might use this time if I get paid another dividend payout on Thursday, so I may buy. I won't be able to buy another share, but if I could, I would. Let's see here. So this one, you do need to own it before August 30th. So that is Wednesday. So you need to pick it up on Tuesday and hold it in your portfolio for market open on Wednesday. You would then get paid out on September 29th. They have an annualized growth of 7.2. So as you know, a lot of the blue chip and aristocrat companies, their annual growth per year for their dividend growth is around 5 to 8%. It's more sustainable in the long term. So if you use the rule of 72, you could see that if you took 72 by 7.2, your money, your initial investment would double in 10 years. Plus with their dividend payout reinvested into their company, that would of course would be sooner. So if you had a dividend payout of $200 within 10 years, it would double to $400, and then within another 10 years or 5 years, it would double to $600, and it just increases the compound. So we already know that they have great dividend history. They did a stock split back in '96 and continue to pay out that that same dividend yield, and they have had really nice growth, nice and consistent growth here. No huge spikes. There was a nice little increase there, 57 to 66. That's a really nice. What's the math on that one? Let's see. 66 and 57. So 0.66 minus 0.57 divide. Oh boy. 0.66 minus 0.57 divided by 0.57 times 100. About 16% growth that year, so really nice growth. So definitely would double your initial investment in more, in less than 10 years. So a good company. Next one is Kellogg's. So Kellogg's, ticker symbol K, is an American global multinational food manufacturing company. So they do have a bit of a lower yield compared to some of these other stocks that we've been taking a look at, 2.97%, but they are currently undervalued. You can see that their dividend greatly outweighs their current price. So their price is about 70, their dividend is 2.93. You can see that their average price and yield is in this area here where they were kind of fighting back and forth for quite a while, and now they've been on a downwards trend. So looks like they peaked and they bottomed out right around $65. So that would have been the optimal time to buy, where you would have got a yield much over 3.10, 3.15%, and then it's been on its it's way up. So this one, it does look like it's on its way up, but at the same time it could just kind of topple. But if you held it for the long term, just looking at they have swings where if you held it for the long term, you would actually get it right now at a decent discount for the year, and then if you continue to hold it for the 5 years, the price always kind of comes back throughout these years. You can see price to yield. Their price and yield back in the 2000 crash, it dropped, so their yield shot up to 4.2%, and then it averaged out right around 2000. I can't see that on this one here. Oh yeah, here it is. 2009 looks like they recovered, and their price had went over their yield eventually, and they kind of evened back out. let's see, so that was Kellogg, so K stock. Let's go take a look at their 1 year and 5 year. So 1 year, they're on a downwards path for the year of 15.35, but again, they bottomed out here in July, and they're actually up 7.13% as of July 11th. So if you would have bought into them, that could have been a nice time for you. They are a little bit price to earning, a little bit high, 31.61, so a little bit higher there. Take a look at their 5 year. 5 year, 35%, so averaging about 7% per year plus dividend yield. So about average with the S&P 500. Now, not crazy 1 year for the past year. That's kind of taking them down a notch. But for if you were to buy and hold this over the long term, you know, you would do pretty well. They've been around since 1906, so I'm sure they do have a long dividend history. So let's go ahead and look up ticker symbol K. So dividend growth 12 years. So they did have growth through the past recession in 08. They are well within the rule of 60, so they are able to reinvest at least 40% back into their company and continue their earnings in the future, and just, you know, come up with different ideas to get, you know, additional earnings. They pay out 54.3 back to their shareholders. Their ex-dividend date is on the 30th, so that is on Thursday. So you need to buy and hold it Wednesday, and then hold it into the ex-dividend date on Thursday. You would then get paid on September 15th. Their annualized growth is only a 3.0, so that's actually really low. With a stock with a dividend yield of 3.09, I would expect their annualized growth to be a little bit higher, you know, 5 to 8% at least. This one has annualized growth of 3.0, so a little bit low. You can see that they increased it by 2 cents there. And this is the next quarter that you're going to be paid out 54 cents for each share. See, they must have had a time, yeah, right here. After the 2000 crash, they didn't increase their dividends for quite a while. They kept it at 25 cents for quite a while. So during the 2000 recession, they pulled back, and they didn't pull back their dividend. They continued just paying out the same, and then once they recovered, they started increasing again. So for the long term, it would be a decent buy and hold. It wouldn't be like a top priority where it's, oh, you know, I need to buy it now. But as you see on the chart, their yield for the 1 year is a little bit above their price right now. So you may be getting it at a discount, where if you wait a little bit longer, you might end up buying it back at $83 range. So that choice is yours. And the last stock that we're going to be taking a look at is LMT, Lockheed Martin. Now this is another one that I wanted to add to my portfolio because, you know, the whole political thing between North Korea, Russia, China, and the United States, there's always some sort of, you know, as you know, Lockheed Martin is an American global aerospace defense and security, you know, it's advanced technology company with worldwide interests. So they like to design a bunch of different things that could be used during war times or defense. So as you can see, their price has been just going up, shooting up for the past 1 year, 3 year. Look at this price. They're at $304. Look at the price that they were at in the beginning of 2017. They were priced around $255, whereas now they're sitting at $304. So is this company overpriced right now? Yes. If you would have bought them in November of 2016, you would have got a yield of nearly 2.87% and bought them at $235. Now you would be sitting on a good chunk right now, right? So definitely right now they are overvalued. So this might be something to add to your watch list if they come back down. Could be a good one to invest in. Let's go ahead and take a look at their 1 year and 5 year. So 1 year, they probably have really nice 22% for their 1 year, and 5 year 229%. That is well over 45%, I believe. It was 229. 229 by 5. Why doesn't it let me do it? Equals 45. So yep, called it 45%, 46% average per year. So very nice growth. Their PE ratio is only 24, so That's actually amazing. Their earnings compared to their price is only 24. Really quickly, I'm just gonna go check Reuters here. Reuters. I just want to see what the industrial average is for this specific field. Just really quickly here while we're talking about Lockheed Martin. And okay, fine. Let's go back. Okay, so let's go ahead and type in ticker symbol LMT. Now this one you would have to purchase by Tuesday. Their ex-dividend is on Wednesday, so you must buy them on Tuesday. They pay out $7.28 per share, which is really nice. They have a payout ratio well below, not well below, but below 60%, and they have dividend growth for the past 14 years, which means they did pay through the 2008 financial recession. So as long as there's not another, so probably in 2003, let's see what their growth was. Their growth was 10%, so that's really nice growth for their dividend per year. Let's see how they did here in 2000. What was it? 2003. Let's see what their stock did. 2003. Let's go right there. Oh yes, right here. 2000. They had the probably, the Y2K crash, the tech bubble that crashed here. They couldn't sustain this $22. They did a stock split. They continued to pay out this dividend of 22. Then they found out they could not continue doing it because after the stock split, so really not bad. What happened? They did a stock split. They did 2 for 1. They didn't pull back their dividend. How normal companies would cut their payout in half because they stock split by 2 for 1. But they continued to pay out the same dividend for each share, and then they had to cut it in half because of the recession. They just couldn't do it. But then afterwards, they didn't have any growth. This time right here, they should have paid out. They should have had some growth here. That would have been nice. They probably lost a couple shareholders at that time, or maybe they continued to hold. Then they had continued growth from after 2003 through the recession. So they might do some pullback in the future. Possibly, maybe, who knows. But do they ever cut their dividend just completely because of recession? No, they have not. They are even a special payback then. So that is it. We covered 5 stocks. We have QCOM, which you have to buy back by this Friday. 6 Flags, which you have to buy on Monday. And Pepsi, you have to buy on Tuesday to be eligible for the dividend on Wednesday. Kellogg's, you must buy it on Tuesday to be eligible for the ex-dividend on Wednesday. And Lockheed Martin, that you must buy on Tuesday as well because their ex-dividend is on Wednesday. So QCOM was undervalued. 6 Flags was undervalued but very risky. Pepsi was overvalued. Kellogg's was undervalued, but at the same time we don't really know what their future goes. It can go up, it can go down, not really predictable there. Lockheed Martin overpriced right now, but again, buy for the long term would be QCOM, Pepsi, and Lockheed Martin. So that is it for this video. If you've watched up to this point, I want to thank you for watching the video. And of course, if you enjoyed this video, hit that like button below and do subscribe to my channel for future financial videos, dividends, and financial videos. So if you have any questions or want to say hello, please leave it in the comments below and I will always reply back to you. Thanks for tuning in, and I will see you next time. Bye.